Ever scrolled through an online checkout and seen that tempting pay over time option? You know, the one that makes that big purchase feel, well, a little less big? We've all been there. But before you click that shiny confirm button, a tiny question usually pops into your head, right? Okay, but what's the catch? Specifically, when it comes to platforms like Affirm, that catch often boils down to one thing: interest rates. Let's be honest, those percentages can feel like a bit of a mystery. They're tucked away in fine print, often buried under layers of financial jargon. And with so many different loan options and eligibility factors, it's hard to get a straight answer. So, today, we're going to cut through the confusion and dive deep into the world of Affirm interest rates. We're going to dissect what they are, how they work, and most importantly, how to figure out what you might actually end up paying. Think of it this way: you're eyeing that new laptop or maybe a fancy piece of furniture. You see Affirm as an option, and it feels like a breath of fresh air. Suddenly, that hefty price tag seems manageable, broken down into smaller, more digestible monthly payments. But what's the real cost of that convenience? Is it a reasonable trade-off, or are you setting yourself up for a financial headache down the line? Before we get into the nitty-gritty, let's understand the basic premise of Affirm. They're a buy now, pay later BNPL service, essentially offering point-of-sale loans. Instead of using a traditional credit card, you can apply for a short-term loan directly at the checkout. This allows you to spread the cost of your purchase over a set period, typically ranging from a few months to a few years. Now, here's where the interest rates come into play. Affirm, like any lender, needs to make money. And they do that by charging interest on the loans they provide. These rates can vary significantly, and understanding the factors that influence them is crucial. The first and most significant factor is your creditworthiness. Just like with a credit card or a traditional loan, your credit score plays a major role in determining the interest rate you'll be offered. A higher credit score generally translates to a lower interest rate, while a lower score might result in a higher rate, or even a denial of your application. But here's the thing about Affirm: they don't just rely on your traditional credit score. They also consider other factors, such as your purchase history with Affirm, your income, and your debt-to-income ratio. This means that even if you have a less-than-perfect credit score, you might still be able to qualify for an Affirm loan, though perhaps at a higher interest rate. Another crucial factor is the merchant you're buying from. Affirm partners with a wide range of retailers, and some of these partnerships involve promotional offers, including 0% APR financing. This means that if you're buying from a participating merchant and qualify for the promotion, you might not have to pay any interest at all. However, these 0% APR offers are typically limited to specific products or purchase amounts and are subject to credit approval. Now, let's talk about the actual range of interest rates you might encounter. Affirm typically offers interest rates ranging from 0% to 36% APR. That's a pretty wide range, and it highlights the importance of understanding the factors we just discussed. So, how do you find out the specific interest rate you'll be offered? Well, the good news is that Affirm is generally transparent about this. When you apply for a loan at checkout, you'll be presented with the terms of the loan, including the interest rate, the monthly payment amount, and the total amount you'll be paying. This allows you to see the full cost of the loan before you commit. Here's a key point: Affirm performs a soft credit check when you apply for a loan. This means that checking your eligibility won't affect your credit score. Only if you accept the loan terms will a hard credit inquiry be made, which can have a temporary impact on your score. Let's break down a potential scenario. Imagine you're buying a $1,000 item and qualify for an Affirm loan with a 20% APR. If you choose a 12-month repayment plan, you'll be paying around $92 per month. Over the course of the year, you'll end up paying a total of approximately $1,104, meaning you'll have paid about $104 in interest. Now, let's contrast that with a 0% APR offer. If you qualify for that same $1,000 purchase with 0% APR, you'll simply be paying $83.33 per month for 12 months, with no interest charges whatsoever. That's a significant difference, and it underscores the importance of looking for those promotional offers. But here's a word of caution. Even with 0% APR offers, it's crucial to make your payments on time. Late payments can result in late fees and could potentially damage your credit score. So, even if you're not paying interest, it's still essential to manage your payments responsibly. Another important aspect to consider is the loan term. Affirm offers various repayment plans, typically ranging from 3 to 36 months. A shorter loan term means higher monthly payments but lower total interest paid. Conversely, a longer loan term means lower monthly payments but higher total interest paid. So, how do you decide which loan term is right for you? Well, it depends on your financial situation and your comfort level with monthly payments. If you can afford higher monthly payments, a shorter loan term might be a better option, as it will save you money on interest. However, if you need lower monthly payments, a longer loan term might be more manageable, even if it means paying more interest in the long run. Beyond the interest rates, it's also important to understand the fees associated with Affirm loans. While Affirm doesn't charge traditional fees like application fees or prepayment penalties, they do charge late fees if you miss a payment. These fees can vary, so it's essential to review the terms and conditions of your loan agreement carefully. Now, let's talk about comparing Affirm to other BNPL services and credit cards. While Affirm is a popular option, it's not the only one. There are other BNPL services, such as Klarna and Afterpay, that offer similar financing options. It's crucial to compare the interest rates, fees, and loan terms of different BNPL services before making a decision. Similarly, it's essential to compare Affirm to traditional credit cards. Credit cards often offer rewards programs and other benefits, but they can also come with high interest rates if you carry a balance. If you're considering using a credit card for a large purchase, it's important to weigh the benefits and drawbacks carefully. In conclusion, understanding Affirm interest rates is crucial for making informed financial decisions. By understanding the factors that influence these rates, you can determine whether an Affirm loan is the right choice for you. Remember to compare the interest rates, fees, and loan terms of different financing options, and always make sure you can afford the monthly payments. Ultimately, the decision of whether or not to use Affirm is a personal one. It depends on your financial situation, your creditworthiness, and your comfort level with taking on debt. If you're considering using Affirm, be sure to do your research and understand the terms and conditions of your loan agreement. With that said, thanks for watching, and until next time.